Welcome back to MSA 690 Financial Statement Analysis. This week, week 5 of the semester, our topic is solvency. I'm trying to tie what we do in financial statement analysis to the material that's covered on the BEC section of the CPA exam. And you'll also see that a lot of what we're covering, particularly with the financial ratios, is also covered in the audit section and the FAR section when those sections cover ratio analysis. Last week, we covered working capital metrics, and there are 6 modules within BEC and Becker. I'm focusing on one of those 6 modules. You know that other parts of BEC also focus on information technology and cost accounting, as well as economics. But we are focusing, last week, we covered M3, M4, and M5 on working capital, and this week we are covering capital structure parts 1 and 2. An entity or company's capital structure is a mix of its use of debt and equity to finance operations. When we're talking about equity, of course, most equity is going to be common stock, but it can also refer to preferred stock. When we talk about debt, sometimes we talk about interest-bearing debt, those loans and bonds payable. Sometimes we're talking about total liabilities. But the company's decision to finance its operations with debt or equity is going to determine its solvency, or its likelihood of being able to pay its debts as they become due. And throughout this video, we're going to be talking about the trade-offs as companies seek to finance their operations with debt versus equity. What are some of the reasons for financing with debt? What are some of the reasons for financing with equity? Again, here's some examples of short-term debt that we've talked about before. Notes payable that are due within 12 months of the balance sheet date. In general, the current portion of long-term debt will be reported in the short-term section. There are some specific criteria that those payments within the year after the balance sheet date have to meet in order to be classified as in the short-term debt section. Another common type of short-term debt is commercial paper, which refers to unsecured, so not collateralized, short-term debt that's issued by a corporation. And what makes commercial paper different from other short-term debt is it typically matures in about 30 days. So it's very short-term, very liquid. And a maximum, in order to be commercial paper, it has to mature in a maximum of 270 days. And it's used to finance either current assets, such as inventory, or to meet short-term obligations. And another example of short-term debt are lines of credit that the company can take advantage of if it needs to, and if it doesn't, that line of credit is there. So if the company is not actually borrowing anything, it's not showing up as a liability. Here are some common types of long-term debt. Secured debt, or also known as collateralized debt. This is debt that's backed by the pledge of an asset. An example of this is mortgage bonds. These are bonds that are backed by property. Debentures are a type of long-term debt. These are unsecured bonds. Subordinated debentures are unsecured bonds that are even riskier than debentures. They fall next in line. And another type of debt is considered, it's reported separately than debt or bonds payable, but it's leasing. Both operating and finance lease classifications are reported on the balance sheet as an asset, the right of use asset, and lease liability. So those lease liabilities, think about it this way. If the company chose not to lease, how would they finance that asset? They would most likely have to take out an additional loan. So oftentimes leasing is seen as a type of debt financing. Benefits of financing with debt. Debt carries a lower cost of capital than equity does. Interest rates that a company is going to end up incurring on debt is going to be lower than what stockholders would demand for purchasing company's stock. And in addition to that, the interest is tax deductible. The higher the tax rate, the more incentive the company has to finance with debt instead of equity. The pre-tax cost of debt is the cost of debt before considering the tax shielding effects of the debt. So pre-tax cost of debt can refer to either the interest rate on debt as a rate, or it can be considered as the whole dollar amount of the total interest expense on the debt. And so far, we've really never talked about, in any of your classes, you've probably never talked much about this, this tax benefit of debt. So every time you've talked about interest expense, we were talking about the pre-tax cost of debt. And the after-tax cost of debt is what the manager of the company really wants to be considering. And that is equal to the pre-tax cost of debt. If you're looking at this on an interest rate perspective, you're thinking the interest rate on a new loan, but we also want to adjust that by 1 minus the tax rate, tax savings on that debt. So here's just a short example. Assume a company's pre-tax average cost of debt capital is 6%. They have a weighted average interest rate of about 6%, and the company has a 20% tax rate. What is the after-tax cost of the long-term debt? Well, then obviously that's going to be the 6% multiplied by 1 minus the tax rate, or 6% times 80%. And so we would look at this cost of financing not as being 6%, the stated interest rate, but rather the after-tax interest expense, which is 4.8%. Obviously, the lower the interest rate, the better. Loan covenants. An entity's capital structure influences the extent to which it is subjected to loan covenants, also called debt covenants. Lenders use debt covenants to protect their interests by limiting or prohibiting the actions of borrowers. What keeps the lender up at night? What's the lender's risk? The lender's risk is that the company it's lending to is not going to be able to repay. And so these debt covenants are stipulations put on the contract that says, whatever the lender decides, your current ratio may not fall below 1.5, or debt to equity ratio must be no greater than 2. Whatever that lender comes up with is what the borrower must follow. When a borrower has a significant amount of outstanding debt relative to equity, loan covenants will typically increase and become more stringent because there is more, of course, risk for the lender. When debt covenants are violated, the debtor is in default and the creditor can demand repayment of the entire principal. It's a way for the lender to say, before things get any worse than they are, give me my money back. I want to get out of this deal. Here are some examples of typical loan covenants. Limitations on the company cannot issue any more debt if they go above a certain dollar amount. Restrictions on the dividends that the company can pay to its stockholders. Limitations on how the borrowed money can be used, perhaps saying you can't use this borrowed money for dividends, but perhaps you can use it to grow actual operations of the company. Minimum working capital requirements and maintenance of specific financial ratios, debt to capital, or interest coverage ratios. And we'll cover those in just a moment. Let's compare debt financing to equity financing. The issuance of stock securities represents different forms of ownership, common stock and preferred stock. remember with preferred stock, dividends and preferred stockholders have dividend and liquidation priority over common stockholders. The rights of shareholders to a firm's asset in bankruptcy, also known as in liquidation, are less than those of both secured and unsecured bondholders. So what are we saying here? If in the event that the company runs into problems paying off its bills and it's starting to run into a risk of bankruptcy, in that case, the secured bondholders come first. Remember, secured means that some assets are pledged. If that loan payments can't get made or interest payments can't get made on that, the lender can come in and take perhaps that underlying building equipment that's being financed. So they have priority in bankruptcy, followed by the unsecured bondholders. And then once those lenders are paid off, the next people next in line to collect cash are the stockholders. And so basically, if anything is left after paying off all the bondholders, then the stockholders may or may not get some cash that's left over. Let's talk about this concept of financial leverage. Financial leverage is the degree to which a company uses debt rather than equity to finance the company. If a borrower's capital structure is heavily weighted toward equity, then its financial leverage would be low and its fixed obligations. So what are these fixed obligations from debt? This is a way of saying interest, right? When a company borrows, they have these periodic, predictable payments that it needs to make, the interest expense. That's different than stock, which there are no. You might be thinking dividends, but dividends are discretionary for the company, particularly for common stock dividends. If a company is low on cash, it doesn't have to pay its common stock dividends, where it does have to pay interest. So if the capital structure is weighted heavily towards equity, financial leverage will be low, and its fixed obligations from debt will be low. There will be less risk that the borrower will be unable to make its interest and principal payments. Of course, the reverse would also hold. If a borrower's capital structure is heavily weighted towards debt, then financial leverage would be high, fixed obligations would be high, and there would be more risk. If a company finances a new project with debt instead of equity, so the company is looking to expand operations, go into a new market, and it needs to finance that, and it's trying to consider, do I want to finance this with debt or by issuing more stock? The company must produce enough operating income, also known as EBIT, earnings before interest and taxes, to cover its, as we said before, fixed interest costs. However, once those fixed interest costs are covered, any additional operating income, or EBIT, will go straight to net income and therefore earnings per share. If a company finances a new project with equity instead of debt, it does not incur additional interest costs. However, the number of shares outstanding the company is issuing more debt, number of shares outstanding will increase, what is that going to do to earnings per share? Net income might be a little bit higher because there's no interest expense, but what happens to the denominator, number of common shares outstanding? Well, that denominator is going to increase, and this will reduce earnings per share. So there's a trade-off here with debt versus equity. A higher degree of financial leverage implies that a small change in earnings before interest and taxes will have greater effects on profits and shareholder value. Another benefit of financial leverage is that interest is tax deductible, dividends are not. However, on the other hand, highly leveraged companies may be at risk of bankruptcy or default or non-payment if they're unable to make the payments on debt. They also may be unable to find new lenders in the future. Let's take a look at an example. On the left here, we have Jana Kingston Company. We see the financing side of the balance sheet. Current liability is long-term debt and the stockholders' equity section. And we see Mary Ann Benson Company has the exact same amount of debt plus equity, or in other words, total assets, but we see the financing is quite a bit different. Jana Kingston has much more in its liabilities as compared to Mary Ann Benson. We see that the companies have the same amount of operating income or income before interest and taxes. They both have the same income tax rate of 20%. From the balance sheet, we can calculate how many shares of common stock that each company has outstanding. We see Jana Kingston has $20 par value stock for total common stock of 2 million. So we know that Jana Kingston has 100,000 shares of common stock outstanding. We can calculate the number of shares outstanding for Marianne Benson by taking the total common stock 2.9 million, dividing that by the par value per share, and concluding that they have 145,000 shares outstanding. Now let's take a look at how the income statement would differ below the operating income section for the two companies. Expense depends on how much debt the company has. So if I go back, I see Jana Kingston has long-term debt 1.2 million at an interest rate, it says here, of 10%. So interest expense will be shown as for Jana Kingston as 120,000, and that will of course reduce the operating income. So income before taxes is going to be 1,080,000, and income tax expense, 20% of 1.08 million is 216,000. This is going to result in Jana Kingston Company having net income of 864,000. Marianne Benson, on the other hand, has no long-term debt, so therefore it has no interest expense, and its pre-tax income is of course going to be 1.2 million. Income tax expense is going to be 20% of pre-tax income, or 240,000. And so Marianne Benson Company's net income is going to be 960,000. So clearly we can see that Marianne Benson has higher income here. But now let's look at earnings per share. We know that's an incredibly important metric used by common stockholders. So Jana Kingston had net income of 864,000, and that's going to be allocated across how many shares? 100,000 shares outstanding. So net earnings per share for Jana Kingston is going to be $8.64, of course. Now, Marianne Benson had higher net income of $960,000, but that's going to be allocated over more common shareholders. There are 145,000 common shareholders for Marianne Benson Company. So earnings per share, 960,000 of income divided by the 145,000 shares gives Marianne Benson Company earnings per share of $6.62. So from an earnings per share perspective, is it advantageous to the stockholders of Jana Kingston Company to have the long-term debt? Absolutely. It avoided that dilution of having more shares outstanding. And also, in addition to seeing this interest expense of 120,000, we have to look at that on an after-tax basis and say, well, we reduced our pre-tax income, therefore reducing pre-tax expense. So the after-tax income is really the 120,000 times 80%. Here's a table that kind of summarizes the trade-off that managers and companies have to make when they're considering, are we going to finance with debt versus equity? Debt has tax deductibility, whereas the cash payments on equity, dividends, do not. We saw in just this last example, EPS dilution did not take place with debt, but it did with equity. However, debt results in increased financial risk. The company could run into bankruptcy because it has to meet those interest payments and it has to repay the principal. Otherwise, the company can go into bankruptcy. That is not the case for equity. The company can raise as much stock as it needs to without ever having to pay that back. From investors' perspective, debt has higher priority in bankruptcy, and that's typically what's going to lead to the lower rates that the company is going to earn, that the investors are going to earn compared to equity. Equity holders have lower priority in bankruptcy, but that makes those equity shares from the investor's perspective higher risk, and therefore the investors are going to, in equity are going to demand a higher return than they would in debt. The investor's return in debt is typically fixed, some stated interest rate, Whereas with equity, it really depends on how the company is doing and the investor's estimation of future cash flows for that company. Now let's turn to take a look at some of the ratios that are typically used in measuring a company's solvency. The debt to assets ratio is equal to the company's total liabilities divided by total assets. Now, the numerator can sometimes be used by analysts as total debt or total interest-bearing debt rather than total liabilities. But for the CPA exam and for most accounting textbooks, we're going to use total liabilities rather than simply just the total interest-bearing debt. So really, the term debt to assets ratio is a little bit misleading. The more technical term would be total liabilities to assets ratio. And this measures the percentage of total assets provided by creditors or lenders. The lower the ratio, the greater the level of solvency, and the greater the presumed ability of the company to repay its debts. Another similar ratio is debt to equity ratio. And when we remember that in accounting, we typically use total liabilities as our measure of debt. It's easy to remember what this ratio is. Total liabilities divided by total shareholders' equity. And it relates to two major categories of capital structure or of financing to one another and indicates the degree of leverage used. When we move on to profitability over the next couple of weeks, we're going to see how this use of leverage can end up making a company more profitable if the return on that borrowed funds is high enough. The lower the debt to equity ratio, the lower the risk. And what risk are we talking about? Of course, the risk of being able to pay back bills. Now notice in these two ratios here, total debt to assets and total debt to equity, we're not talking about average balances, we're looking at total balances on both of them. The reason we don't need average balances is because what are we comparing? The numerator and the denominator, they're both at one point in time. We needed average balances in the past when we were comparing an income statement number in the numerator of a period of time to a balance sheet item that's measured at a point in time on the denominator. Here we don't run into that issue, so we don't need to worry about average balances. And there's one more very commonly used solvency ratio called times interest earned. And this is equal to net income plus interest expense plus income tax expense. In other words, income before interest and taxes. Divide this number by interest expense. And what we're saying is your income before interest and taxes was how many times greater than interest expense? And this gives the lender an indication of the borrower's ability to repay that interest expense. So we have here measures the ability to meet interest payments as they become due. And of course, the higher the better. Or the higher the times interest earned, the lower the risk. Let's take a look at an example. Edgewell, Procter & Gamble, and Colgate. Let's compare their capital structures and their use of debt financing. For assignment 4, you're going to do a similar example to what I'm doing in this video, except that you're going to use Target, Walmart, and CVS. One thing to note when you're looking at CVS, for some reason their income statement is in dollars, but their balance sheet is in millions of dollars. So if you don't make any changes, you're going to notice some really crazy results. So just make sure that when you're doing your income statement numbers on your assignment, you're converting those into millions of dollars. So here we see I've filled in total assets, total liabilities, equity, interest expense, and operating income. I did each of these just going to each company's income statement and balance sheet. Finding operating income, you'll see here for Edgewell, they don't specifically give me operating income. They have both their operating expenses and non-operating expenses all listed. So I solved for operating income just by looking at this and saying, I think SG&A is definitely part of operating income, advertising and promotion, operating, R&D operating. And I made the decision that restructuring, impairment, and everything else that we see here is more similar to non-operating. So I just calculated the operating income here. Operating income and interest expense were given for the other two companies, and we had interest expense for Edgewell. Oh, no, we didn't have interest expense. Oh, yeah, interest expense associated with debt for Edgewell was given. So we need to solve debt to equity for each of these companies. Pretty easy once we have our information here. And then I can copy and paste this over for each one of my companies. And what do I see? I see that Edgewell and Procter & Gamble are very similar in their debt to equity ratios, very similar capital structure. But check out how different Colgate is. They've got 13 times more debt than they do equity. And we can see that they have just a very small portion of equity. So most of their assets, almost all of their assets are financed with debt. So what would we say about Edgewell's debt to equity, or what would we say about solvency over the time period? Over the 3 years, it went from 1.27 to 1.47. So we would say that the company's solvency is decreasing or deteriorating over time. About Procter & Gamble, their debt to equity ratio went from 1.24 to 1.57. So I would say the same. It's either decreasing or deteriorating. And Colgate-Palmolive, their debt to equity ratio was 49.23, and it fell consistently each year down to 13.46. So we would say that this is improving, but we would also say that Colgate-Palmolive's debt to equity ratio is much, much higher than Edgewell and Procter & Gamble. So down here I have which company appears the most solvent in the most recent year in terms of debt to equity. And so we would want the lowest number, and so that would be Edgewell. Let's do the same thing for the debt to assets ratio. This is just another way to look at how the company is financing. It's another way to look at its capital structure. I see that the debt to assets ratio went from 56% to 60%. So again, debt to equity, this would be decreasing. Same thing for Procter & Gamble, decreasing over time. And we see that debt has become a smaller proportion of assets, so solvency is improving. But of course, when we look at the absolute numbers rather than the changes over time, we would see Edgewell is very, very similar to Procter & Gamble, maybe just a slight advantage over Procter & Gamble, but they're very, very similar. Now let's look at times interest earned. You'll notice that these first two measures didn't look at anything related to income. Times interest earned looks at interest expense, or operating income. How many times greater is it than interest expense? Obviously, higher is better. And what do we see here? We see times interest earned for Edgewell is decreasing or declining. Solvency is declining. We see that it's actually improving. So while Procter & Gamble is increasing the amount of debt to equity or to assets, from an income statement perspective, as long as that debt is producing income, then it reduces the risk for the company and for the lender of the company. So we see when I'm comparing Edgewell to Procter & Gamble, we see that the solvency from an income statement perspective is much better for Procter & Gamble. And then finally for Colgate-Palmolive, it's kind of somewhere in between Edgewell and Procter & Gamble. Over time, it is showing a slight improvement. But when we look at which company has the best in the most recent year, clearly that's going to be Procter & Gamble. Now you're going to do the same with Target, Walmart, and CVS. But before we conclude, let's just look at a few true-false practice questions. Equity financing has a higher cost of capital than debt financing. True or false? The answer to that is true. We said in the slides, debt carries a lower cost of capital. The reason for that, again, is because debt holders have a higher priority in bankruptcy than the equity holders, so they're willing to take a lower rate. Next, a company with high operating leverage uses more equity than debt. True or false? This is false. Financial leverage is the degree to which a company uses debt. So operating leverage is not part of this. We are looking at financing leverage, and financing leverage is looking at using more debt than equity. An increase in the times interest earned ratio indicates an increase in solvency. True or false? The answer to that, of course, is true. Higher values indicate stronger solvency. The more operating income is available to cover interest expense, the better off the company is. And finally, if a company purchases shares of its own stock, treasury stock, its debt to equity ratio will increase. True or false? So think about what happens, the debt to equity ratio, total liabilities over total stockholders' equity. The only change is that a company purchases shares of its own stock. Clearly, that's not going to do anything to debt. Will that do anything to the company's stockholders' equity? Well, we know treasury stock reduces stockholders' equity. So true, the denominator, stockholders' equity, will decrease, and that will result in an increase in the debt to equity ratio. And this concludes week 5 on capital structure and solvency.